There we go. Get the camera working again. All right. Oh, welcome everyone to Trading Coach's Playbook. My name is Brandon Wendell. I'll be your host for a little while here as we go through today's lesson. Today's topic is going to be options on futures. So we'll talk a little bit more about that. And let's see. I will take a look back at that, Alex. I apologize. I may have missed the email message. So I'll go ahead and check on that for you and get back to you on that. Absolutely. So I'm a little behind on things. I got caught up in life. Let's put it that way. But yeah, I'll take care of that for you. So anyway, my name is Brandon Wendell, as I mentioned. I've been involved in the markets for almost 30 years now. Can't believe it. Started off as a retail broker, moved into back office operations where I handled order flow for a retail brokerage. Then decided to become a private hedge fund trader for a little bit and got to see how that action works as far as large order flow on wholesale basis, and then decided to just trade for myself, and that's what I do. I also got into education and helping others to kind of become better traders overall, and that's what I kind of balance out right now is my own personal trading as well as education. I help out with several programs, as you see behind me. Got the E-mini Think Tank, Wealth with Spreads, SPX Cash Flow Secrets programs. I'm going to talk a little bit about E-mini Think Tank today because one of the things I'm going to be going over is something that we cover extensively in the E-mini Think Tank. And let me just check. Hold on a second here. Too many pages open. There it is. Okay. It's looking for my browser, which I'm logged into Wealth Builders HQ and the E-mini Think Tank. So basically, I have a lot of education there. You can see there's class recordings. We record because we meet several days a week, Mondays, Wednesdays, and Thursdays from 9 a.m. to 11 a.m. So we go over a lot of the tactics and strategies that I've taught. Right here under new trainings, there's education based on certain strategies I use, as well as indicators I use, and basically how I read price, all the secrets, if you will. And one of the things we just recently went over this week and recorded for a lesson is options on futures. So I want to talk a little bit more about that and how it can give you the opportunity to trade with leverage on top of leverage. But before we get started, just need to remind everybody that we're doing this from an educational standpoint. I'm not giving any personalized recommendations, especially if we look at the markets. All trading does involve risk of loss, and we can never eliminate that risk. We try to minimize and manage it, but it's never, we can never completely remove it. Also, we're not subject to trading restrictions, so we have positions in securities or initiate them at any time. And as I said, I'm pretty active in the markets on a regular basis. And right there, the E-mini Think Tank. If you want to join me, you can try it out for free if you do a quarterly subscription, because there's either monthly or quarterly subscriptions. But the quarterly comes with a 2-week free trial, so you can kick the tires, so to speak, and see if it's the right program for you and learn more about the futures markets. And like I said, we meet live 3 days a week. If you can't make it live, you still get the trade ideas that I put out. I email them out to all the students. Plus, uh, again, everything's recorded. You can go ahead and watch those recordings. So you can stay in touch with us regularly. There's also free workshops that we do. Obviously, this Trading Coach's Playbook, as well as Power Hour every Monday that Rob does and talks about timely topics in the markets. And then there's other workshops and products as well. And of course, you can always stay in touch with us. BrandonWendell.com, my personal website. Might as well direct you there as well. Let's see, they updated that. So BrandonWendell.com. There I am, wearing my funky suit that I love. I haven't worn that in a while. I need an occasion to do it. But again, you can take a look to see some of the things about me, but more importantly, the different programs, like I said, the E-mini Think Tank and the others. So if you're interested in learning more about futures, E-mini Think Tank is definitely the place to go. There's also the Futures Bootcamp. If you've never traded futures before, you're kind of new to that and want to learn more about it, that's where you would go first. But then the interactive kind of lifetime support would be with the E-mini Think Tank for futures trading. And again, also not just futures, but options on futures. And this is, there we go. Before I go there, let me see, close that one out. This is what we're going to be talking about today. And as I said, this is available, the full session is in the E-mini think tank. I'm only going to kind of scratch the surface and give you a little bit of information about what these are and how we deal with them, how we differentiate them from other options. But basically, it's trading leverage on leverage. One of the things that happens when you trade futures is you get to trade using a margin deposit, and it gives you extra buying power, what we call leverage. So for an example, if I were to go to, let's go to CME Group, and we want to trade gold as an example. I'll go to gold. All right, there it is. And under gold, you can see it shows gold futures, and the notional value estimate right now for 100 ounces, you're basically trading $340,000 worth of gold. However, the margin required to be able to trade that is only $15,000. So you get to trade something worth 300 over almost a quarter or over a $250,000 for only about $15,000. That's that extra buying power. That's leverage. And you can see if that's a little large, you can trade micro gold. They have mini golds. They have all sorts of different kinds of contracts available. Actually, we have 1 ounce gold now available. So even smaller, $3,400 of gold is 1 ounce for $150 a margin, roughly. But in addition to that leverage and that opportunity, we can add options right here. You see gold options and micro gold options. And the nice thing about that is, again, we're already trading on leverage with the futures. Now we're getting leverage using an option on the future. So rather than having to come up with the entire margin, that's required for a futures contract, you only have to buy and put down the margin that's required for the options contract, which could be much, much less. So you're getting leverage on leverage. It seems great. It means that you only need a small amount of capital to control something worth huge value, and it can increase and magnify your gains. So everybody looks at that and thinks, wow, that's awesome. The problem is you are also magnifying and increasing exponentially your risk. Anywhere you look in the markets, you cannot increase your reward without increasing risk. If you can, let me know, because I don't know of any other way of doing that. Basically, anytime you increase your rewards, you increase your risks, period. So we got to be careful when we're doing this, because if things go against us, it is possible to lose more than that deposit that you put down, even possibly more than you have in your account. So you definitely need to be careful with that. Now, when it comes to options on futures, if you're familiar with stock options or options on indexes, stocks, ETFs, they're all very similar. Options are contracts, and a contract basically has 5 pieces. That's it, minimum. There can be extra pieces, but for the most part, in order to make it a contract, you need a buyer and a seller. You need something that's going to be delivered. You need compensation for that delivery, for that product, and there has to be an expiration date. Those are the 5 things you have to have. So you have to have a buyer and a seller. And in the case of options, they're just contracts. The buyer of a contract basically pays a cost, and that's called premium, and they gain the right to do something. They now have the right to buy or sell something. The seller, when they enter into that contract, they receive the premium because they're receiving compensation to enter this contract. They're assuming an obligation. Now, when you are a buyer and you gain rights, you can choose whether to exercise your rights. You do not have to. Okay, it's totally up to you. It's your discretion. But obligations must be met. So the sellers are under a stricter set of rules, if you will. They have an obligation that they're assuming, and they must meet that obligation. The only way to get yourself out of that would be to get rid of that contract by closing it out, basically buying back the obligation. So this is the same, as I said, even futures themselves are a contract. So we are actually trading options on futures, or futures options, whatever you wish to call it. You are trading a contract on a contract. That's pretty much what it is. So options are options. A lot of people look at different strategies. As a matter of fact, I have TradeStation open right now, I believe. And I went to Option Station Pro. So if I go to my options and I will go to QQQ, which is the ETF that tracks the NASDAQ 100. There it is. And we see my option chains. I'll just go to today's options just for the heck of it and just show you. Let's see. Let's go to just 6 strikes. So we have our calls, we have our puts, right? Bid and ask and all the Greeks, and we have lots of different options available to choose from, different expirations. Ones that expire today, Monday, Tuesday, next week, Wednesday, and all the way out to December 2027, right? Well, if we go out to NQ, actually, we'll do it this way. Thing at NQ, let's see if that works. Nope, I have to do specific, I think. I'll go to NQU25, which is the front month contract. And right there, those are the options on that front month contract. Once again, I've got calls and puts. Now, on that contract, I only have certain options available depending on which brokerage you trade through. We check the December. Yep, it's just showing the monthly options right now. So TradeStation, by the way, in order to trade options on futures in TradeStation, you can do the analysis on OptionStation Pro, but it will not allow me to trade it. Watch what happens. I click on it. It says, wait a minute. For futures options, it only supports viewing data and analysis. To actually place the trades, you have to use TradeStation's Futures Plus. That's a separate platform. It's free, so it's not a big deal. You can get it real easily, and I do have it actually. But for analysis, I can just analyze it using this platform. So the platform Futures Plus, by the way, see if I open this up. Nope, that's good. It's done. Where did you go? Oops. Cannot type today. There we go. It's web-based for Futures Plus. Yeah, that's the right one. Oops. I get the code. Okay. And it takes a moment to load. And there's other platforms you can use. I don't think I have my Thinkorswim open right now, but I can open that up and use that as well. Yeah, it's not open right now. I don't want to run too many programs in the background. It gets a little bogged down on my computer. And we'll close that. There we go. So, as a matter of fact, I do have the NASDAQ options right here. I was mentioning that there may be other options available, and there are. And I'll zoom in over on that area. You can see we've got June, September, December, March. So we've got how many days left in the contracts for the expirations. June 2025 NQ should have expired already. So this will hopefully update and show me. Actually, no, contract hasn't expired yet. Has it? Yeah, it is. We're in July. What am I thinking? And that's why it's not populating. So it should drop off, but there we go. September, that's tradable. And you can see that when it comes to these options, remember, we're trading contracts on contracts. So notice that's the September options contract. The underlying security is the NASDAQ September futures. The December contract for the option, though, is based on the underlying of December NASDAQ, because when the December contracts are trading, that September might expire, the underlying. You have 2 different expirations to deal with when it comes to options on futures: the futures contract expiration and the options expiration. So when you're looking at different securities, let's see, this is platinum. It's loading. There we go. Notice right now, I've got the August 2025 contracts. The underlying is the October platinum contract for futures. The September options also use the October futures as the underlying. And the October options also use the October futures. So multiple contracts can be available on a single underlying futures contract, but you cannot have an options contract on a future that's already expired or expiring before the option does. So that's the way it works. This is Swiss franc. And notice there are 3 contracts. August 2025. There's different expirations. And then September 2025 that are still based on the underlying September contract. So it's a little bit of a different animal. Obviously, you have to deal with the underlying as well as, oh, yeah, there it goes. It shows you that's expired contract. So I got to use the unexpired. Anyway, where was I? Moving along. Oh, come on. This froze up for a moment. Don't do that. There we go. So what I was going to say is the strategies in math that we use when it comes to determining options on equities or options on indexes, they work the same way on options on futures. As a matter of fact, if I go back to my Option Station Pro, and let's go to, let's see, bring in a new one, CME, and we'll take a look at crude oil futures. Just got to scroll to find CL. Good question. Is there early exercise on European, or I'm sorry, on options on futures? I'm actually going to answer that in just a few moments. The simple answer is maybe. It depends on the style of option. We actually have 2 styles of expiration and exercise. One is American style, which is what we have on the equity markets, meaning you can exercise whenever you like and possibly be assigned at any point when you own the option or sold the option. In the futures market, however, we have European style options, which cannot be assigned or exercised until the expiration. Let's see, here we are, CL. There it is. And it's actually LO for the symbol. I'll show you where you can find the symbols in a moment. So I'm loading up the options right here. It shows me it's loading. And these will be crude oil options when it loads. So continuing on. Oh, actually, there it is. I wanted to point out something on this. Now, there are certain tools that you can use in the TradeStation Futures Plus, and there's other tools, again, available in different platforms. In this particular case, if I want to trade these options and I want to create positions, let's see, we have strategy creation. Now, it doesn't work in simulated mode, but if I decide I want to do, let's say, a vertical spread, I can go ahead and create a vertical spread by selecting this. And all of a sudden, all I have to do now is fill in. I know for a vertical spread, I'm going to be buying a contract and selling a contract. So once I do my analysis, I would be buying a contract. Let's say we're doing a bull put spread. I would buy a lower strike and sell a higher strike. And I just fill in which ones I want to trade. It's pretty neat. Or if I want to do a little more complicated one, perhaps I want to do an iron condor. I just find the template for the iron condor, and it is sell, buy, sell. Or if I'm doing a short, I just reverse these, buy, sell, buy. And then I just fill in for the strategies. And again, it's the same type of strategies that you would use on equity options. So if I go back to Option Station Pro, again, all right, come on. I don't know why it's not showing up now. There's TradeStation. And OS Pro, and pop up. It's running into some issues all of a sudden. Bring up a chart on this page as well. Sorry about that. I might have to switch platforms if this is going to give me problems. And close some stuff out as well. Yeah, let's close it. There it goes. Okay, so now we'll do it again. And Option Station Pro. Sorry, I'm having a little bit of allergies issues. Anyway, there we go. And again, if I wanted to on crude oil, CLU 25 and typed in C twice. Why is it doing that? There we go. You can see I've got quite a few different choices for that September contract. And I can go ahead and choose Iron Condor. Condor there. Where's Iron? There it is, Iron Condor. Nice. So I can create these positions and analyze them. Oops, gotta hold down the control key. There it is. And again, open, buy, sell, buy. I just put in the numbers that I wish based on my analysis, and they give me to analyze this position as well and figure out, is it a good position that I want to take? And then, of course, I could place it on the other platform. So the same strategies and same type of math, we're using I think it's Black-Scholes for the analysis here. You can use the Bergstrom, whatever it happens to be, to figure out theoretical values and all the good stuff. But the point is, everything's transferable. It works the same way on the futures options as it pretty much does on the equity options. So same strategies and math. The neat thing is on options on futures, you have more ability to protect yourself because the market doesn't close after 4 p.m. In equity options, you can only trade between 9:30 in the morning and 4 p.m. In options on futures, they're open the same time as the underlying futures contract, and the margins are the same as well as the underlying futures contract. Or I should say, the style of margin they use is called span margining. Again, I'm having a heck of a Friday. But anyway, so it's not the exact same level. Again, when we take a look at the CME Group website, if it lets me, for instance, micro gold, we had margin around 1500. I can actually go into a tool that I have here in the CME website. I'll close other things out. And if we were trading micro gold, I have a margin calculator I could use for this. And I go through this in much more detail and slower to show you where everything is inside the class, as I mentioned before. But let's say we want to trade micro gold MGC. Oops. MGC. And we'll trade the October contract. That's the next one that's going to have the most volume coming up as soon as we roll out of August, if we haven't already. So if I want to trade one micro gold contract future, the initial margin, overnight margin, is 1650. Maintenance is 1500. So I'd have to have that particular margin to trade the futures contract. Now, what if I wanted to trade a call option instead on that micro? Well, I could check the margin on that. MGC call. MGC. Oh, I forgot to change over to option. Let's do that. MGC. Saying no options. Let's see. Micro gold. There it is. Micro gold options. OMG. That's the symbol. So the symbol is different for micro gold than it is on gold or even micro. And I said I might be doing the October. So we'll go to October call. And the strike price, I'm not sure what we're currently trading at. I can actually look. Going back over to MGC V25. With the options. This is micro gold, and those are the different options available on it. We're trading right now about 33.87. So an at the money call, strike price. This is showing me 23. I'll just click on one randomly for now. Just do one just to get an idea. add to preview, save and margin. And the margin for buying that option obviously would be the cost of the option, the premium. And you can see initial margin and total margin. However, that's not the one I'd want to use. It's probably chosen a different one in the short side. If I do the short side or even a spread, it'll show me exactly how much margin I'd have to come up with. And it's typically going to be less than what you would for the actual futures contract, the underlying. So that's kind of neat that we could trade those options. Again, reduce costs, possibly reduce risk. And we use what we call span margin. I can't remember what it's called, what it stands for again, specials. I don't know. I'm not going to pretend. But futures options are a little more sophisticated. And because they're more sophisticated and there's things that happen, you have to be aware of it and protect yourself. Again, going back to the CME Group website, there's another tool I can go to. Let's go to the home page here, CME Group. And it's called Contract Directory and Calendar Tool. You can just do a search for Contract Directory on their website, and there it is, first tool. And this will answer the question that Jeff had just a little while ago. For instance, if we go to gold metals, there's gold. I click on that, and here are the different options available. Again, I was looking at October, and perhaps I want to trade an option on gold. Let's see. There we go. That is a September option on gold. And the underlying security, if I click on future, it'll show me what it is. It's actually based on the October contract. Now, the option is American style. That means it can be exercised at any time. So yes, you can have early exercise. Additionally, it is deliverable for the options expiration method. This is the page that tells you all the information you want to know about your option you're trading, and even the future. So again, it's called Contract Directory and Calendar Tool. By going here, I can find my option I wish to trade. You'll notice there are weekly options as well that are available. We have options that expire on Monday, Wednesday, and Friday every week. And you can check to see what they're based on. The OG3U5, this is Friday option week 3. And you can see when it expires, when it was available to trade. When you click on future, it shows you what it's based on. It's still based on that October contract. And I go back and it says it's American style, which means early exercise is possible and it's deliverable. Deliverable means that you're not going to get gold. What happens is deliverable in this option on future, when you exercise a call, for instance, in a stock option, what happens? You're long a call option, you exercise your call, you get the right to buy 100 shares for every contract of that underlying stock at the strike price. Well, simple. Here, if you exercise your call option, you now are long one futures contract at the strike price. That's it. If you sold a call, you would have to sell stock, right? If it was a stock option and you were exercised or signed. Here, you would become short the futures contract. And you must have enough money in your account to cover that margin as well. Remember, if we create a position on an option, let's say we buy a call option on crude oil, right? Well, if I buy that call option on crude oil, let's go to this platform. Again, I was looking at the call options here for September on crude oil, and I decided I want to buy this, okay? The margin to buy this is whatever it normally costs, which brings up another point. When you look at a quote for an option on stock, right here, let's go to USO, that's the crude oil ETF. And let's say we're going to do September options, fine, doesn't matter. Single. The 76 call option, right? If I want to buy that 76 call option, it shows $3.95. But how much is that really? Am I really paying $3.95? No, that's per share. I'm paying $395 because with a stock option, you have to multiply by 100, right? It's what the underlying security is. So with the futures option, you have to make sure, I'll go CLV25. Where's a U? I use V, it doesn't matter. No, actually, I should use the U. There we go. And bear with me a moment. There we go. Once again, if I wanted to buy a call option, I click on it. Let me delete this one first. I'll do 67. Oh, forgot. Gotta hold down the control key while I'm doing this. Otherwise, I get the error message. So here I am, and I'll do the natural price, and it's saying $1.81. Well, we don't multiply by 100. You are trading crude oil. And one of these options represents one contract of crude oil. Well, what is one contract of crude oil representing? Well, if you don't know, you probably shouldn't be trading this, but if we go over to our chart on TradeStation, I bring up CLU25, which is crude oil that we're looking at here. I can go to a daily, it doesn't matter actually, say on this chart, I double click on the chart, and under properties, it shows me the big point value. The big point value is 1,000. I'm basically trading 1,000 barrels of crude oil with one futures contract. So one option on futures contract represents 1,000 barrels as well. That means whatever price you're seeing here to buy that option, you multiply by 1,000, and that's the actual cost. It's not $1.81, it's 1,800. Now, here's the tricky part. Every future is different. If we go switch from CLU to ESU25, now we're trading the S&P 500. What's the point value? Again, if I'm looking at quotes here, I'm looking at, 161. Well, you can't multiply that by 1,000 because that's not the right size. You need to multiply that by the point value of the underlying future. So again, we can go back to TradeStation, wrong one, and ESU25, double click, big point value is 50. So whatever the point value is of the underlying future, that's what you have to multiply your quotes by, and that is what you're actually paying. Well, 161.25 times 50 is 8,062.50. It's still cheaper than buying an underlying futures contract, right? What is the ES margin right now? Easy way to find that. Again, contract directory. Oh, no, that's not where I would go. Actually, we're trading on TradeStation. Pricing, futures margins. Energy, crude oil. There it is. Day trading margin, $1,700. I'm holding it overnight on a long, $6,800. But if I bought the call instead, come on, $8,000 for that call option. So in this case, it's actually cheaper to buy the future, although I don't know if that's been updated. It may not be updated properly. I'll have to check. You can always check on the CME Group website as well. Remember, I got that margin rates available. I think I might have closed it out. Yeah. Margin, futures and options. Obviously, there's a lot of tools and a lot of things to consider when you're going to trade the options on futures, but it becomes very easy if it's explained to you slowly. I'm going through this very fast, just trying to give you an idea of what it's all about. However, in the lesson, I go much slower and show you all the resources in a pace that you can understand and use, obviously. So looking at the futures contract here, if you were just trading one CL contract, let's see what the margin actually is. Oh, no, it is. It's $6,600. So right now, the futures might be a little overvalued because it costs more to buy the future than it does to buy the underlying contract. But, that's what happens in trading. You've got to want to buy based on the value of the contracts and maybe sell overvalued. Anyway, oh, you know what? I'm bad. I'm looking at the ES here, not CL, dummy. That's why it's so different. Ugh. And nobody called me out on it either. Anyway, it was the ES, not crude oil. I was thinking it should be cheaper to do the option. So anyway, here on ES, yeah, there you go. Overnight margin 23,000, but doing the option, the call option, that makes a lot more sense. The call option was only what, 8,000? Yeah. So you save quite a bit of money typically doing the options versus doing the futures. That's one of the reasons why we trade options instead. You get a discount in trading. So again, going back to, here we are, but they are a little more complex. Again, you got physical delivery. Oh, that's what I was trying to show too. Going back to the contract directory tool, if we go to a different product to answer Jeff's question, for instance, natural gas, if we take a look at the nat gas options, notice this one says European style. Anytime you see European style, there is no early exercise. You can only exercise or be assigned at expiration. Additionally, there's not a delivery. Remember what I said, if you buy a call option, let me just do it this way. There we go. Buying a call. Basically, if you exercise, what happens? Well, you're long one contract at the strike. If you sell a call and you're assigned, you are now short one futures contract at the strike. It's the same as it would be for stock, but it's the futures contract that you're long or short. If you buy a put and you exercise, well, then you would be short a futures contract. Oops. At the strike. And if you sell a put and you're assigned, then you'd be long a futures contract at the strike. Now, there is an exception to this. Okay. Basically, like I said before, you have American style. Should be hyphenated. Basically, you can get that early exercise or assignment, but European style, only exercise or assign at expiration. Now, for delivery, we have two types of delivery. Physical, which basically means you buy or sell the futures contract at exercise or assignment, as I mentioned it above. Not goo, it's you. There we go. However, we also have financially settled. It's also known as cash settled. And you get paid or have to pay at exercise or assignment. So basically, in this case, loser pays winner. based on the strike and settlement price. That's it. Saying the strike and the settlement price, whatever. But that's the way it works. The loser pays the winner on financially settled options. So when we go back to that one that we were just looking at here on exercise style European for natural gas options expiration method right there, it says financially settled. That means if you decide to exercise at the expiration, because that's the only time you can on European style, if you are in the money, you will receive compensation based on the intrinsic value of that option, how much you won. If you were short and you lost, you'd have to pay that amount to the winner. That's all. Pretty simple. Now, the exception, as I mentioned, on the physical delivery one, there is an exception. If the futures contract, expires at the same time as the option, you can't get an expired contract. It becomes cash settled no matter what. So if you actually own a physically settled option, but the option and the future expire at the same time, say you hold it to expiration, then it has to be cash settled because you cannot be taking delivery or open a new position in an expired contract. It doesn't work that way. So again, you have to know these things when you're trading these options on futures, and you have to know your futures in order to be able to trade them properly. So going back a moment here, what do we have? We were looking earlier at, let's say, agriculture, corn, and we look at a corn future. And this is corn options, OZC is the symbol, V25. That means that's October 2025. The expiration is actually in September. It is American style, and it is deliverable. So you can exercise whenever you'd like. And if you do, again, if you buy a call, you might actually receive a long position in the futures contract at the strike price. If you buy a put, you'd be short the futures contract. But we take a look here at the future expiration. Well, that was a December one, so we don't have to worry about it. But if the option and the future expired on the same day, you would not be able to get delivery of the underlying contract. So it would be cash settled, even though it's normally deliverable. That's how they get around that. And this is how you know which one you're trading. I go back and choose something else. Let's say we want to do some crypto options on Bitcoin. Okay, we actually have BTCU 25. That's the September option. It's European style, so I cannot do early exercise. I can hold till the expiration, and it's deliverable. Well, which one's it based on? Oh, look at this. Okay, let me see. Do I have this? Hang on one moment. Zoom it. Perfect. There we go. So we have the option. Again, the option expires, as you can see, 11 a.m. on the 26th. So if I buy that option, it's European style, I can't exercise until expiration. If we're in the money and this is expiring, it's deliverable. So I should expect to get a futures contract. However, if I click on the future, notice it's based on a contract that expires at the same time. And because it expires at the same time, it's going to be financially settled. And the futures contract's financially settled anyway, cash settled, meaning loser pays the winner. But in the case of my option, because my option and future expire at the same time, if I held this expiration and we had intrinsic value, I would get cash settlement anyway. I cannot get an expiring contract. They won't give that to you. So it's good to know these things and what's going on, and that contract directory tells you that. So basically, looking at the two, the differences are what you're trading on, not the option. The options are the same. Calls are calls. You know, they give you the right to call away stock from somebody. If you buy it, they obligate you to have stock called away from you, or a futures contract in this case. A put allows you to put something to someone if you buy it, or you have something put to you if you're short. Well, the underlying is going to be one futures contract for every option. Stocks and ETFs is 100 shares. Here's just one contract. Exercise style, we introduced the European style. The difference between the two, American style, you can exercise whenever you want, and you're at risk of assignment whenever you enter in a short position. In the European style, you avoid that early assignment because there is none. Okay, you can only exercise or be assigned at expiration with European style options. Settlement. I didn't really mention this, but with the settlement, it is daily. Now, you're not going to get delivery of the futures contract. What that means, if it's cash settled, money will be deducted from your account or added to your account every single day at settlement time, whatever that settlement time is for that security you're trading. However, at the expiration or at the actual exercise or assignment, then you would get delivery of the underlying security at that point, which is a futures contract. The quotes, when we look at those levels, those quotes there in the market, again, whatever you see being quoted here, 228 or 212 in this case on crude, it's crude oil. You got to multiply that by the point value to see exactly how much that contract will actually cost you. Yeah, there are definitely better times to trade these than others. It depends on when the hours of the underlying security trade. So going back right here, does it show you on this one? Yeah, trading hours right there. So you have what they call the old pits, and usually the volume is going to be better during the old pit sessions. However, you can trade whenever the Globex session is open, because that's what we trade through as retail traders, Globex. But it's just like the underlying securities. If you're trading, here we go. Well, ES as an example, and I'll go to a 60-minute time frame, maybe 30-minute. Here we go. Studies. Volume. You can see when it's best to trade those. Oops, wrong way. When the volume is very high, 9:30 a.m. to about 4 p.m. After hours, the volume is light. The options will be the same. The volume will be much heavier during regular trading hours than in the after hours. Does it mean you can't trade them? No, of course you could. If I wanted to trade live cattle, all right, that would be LC, do V25 in this case. Once again, this is only open during certain hours. So this market may not be available for after hours trading because the futures are not available for after hours trading. This one only trades 9:30 until 2:05, 2 o'clock, basically, showing you the close. So the options market's only available then. They're not available after hours because it's again, the futures contract and the options contracts are available at the same time. So if I were to go to agriculture, live cattle, there it is. And I'll just choose this LEV. You can see when it's available. And the options market, Globex, 8:30 to 1 Central. That's it. You can't trade after hours there. It's just not available because that's only when those are the only hours when that trades. However, corn, Globex, that's open from 8 p.m. Eastern to 8:45 a.m. Eastern, and then it closes down to 9:30 and then wakes up again until 2:15 p.m. Eastern. They show Central Time here, just be aware. So not everything is available after hours, only certain contracts are. The nice thing is the equity markets are available. So when you get those big news moves or announcements that happen after hours, you can actually trade the options on equities, for instance, the NASDAQ right here, because those are traded after hours. This one's open. Where is it here? Globex schedule right there, 6 p.m. Sunday till 5 p.m. Friday Eastern with a small maintenance period. That's the only time it's shut down during that maintenance period, 5 to 6 p.m. Eastern every day. So yes, it's better to trade those after hours when you can because others you cannot. Tick size, the way things move is also based on the underlying security. So they base not on dollars and pennies like options on stocks do, but based on the underlying security. If it's crude oil, it moves in pennies. If it's nat gas, it moves in tenth of a penny. If it's corn, it moves in quarters or eighths. They actually use eighths, but it's 2/8, 4/8, 6/8. So you have to get used to that as well. As I just mentioned, the trading hours could be as much as 23 hours a day, like for equities, 5.5 days a week, opening on Sunday, closing on Friday afternoon. But it just depends on what you're trading. The live cattle is only open for several hours a day, Monday through Friday, that do not have the weekend hours. So it all depends on what it is you're trading. And the other nice advantage, if you are trying to day trade options like zero DTE, and you get in and out of options on a regular basis, you might run in afoul of pattern day trading rules. If you're trading options on futures, they have the same 1256 contract that they fall under as the futures contracts do. So your taxation may be better, meaning you get long-term capital gains versus short-term, and you don't have to worry about pattern day trading. Pattern day trading does not exist on options on futures. So those are some of the advantages for trading those. But as I mentioned before, you got to know what it is that you're doing. And there's a bunch of lessons. Believe it or not, I did 2 lessons, 2 hours long. And we're continuing to expand on that in the E-mini think tank. So that's where their slides are actually from. And I only gone through a couple of the slides. Yes, you do need a margin account to be able to trade this. However, you can trade, I take that back because you can trade options on futures in a retirement account. You can create retirement IRAs that allow futures trading, and you can trade options on futures in those accounts. So yeah, you could possibly do it with certain cash accounts, depending on where it is you trade and whom you trade through, which is kind of neat. So where was I here? I was looking at, oh, wrong one. Trying to bring up my, there it is, Option Station Pro. And of course, it's not popping up anymore. Trade Station. OS Pro, come on. See when it does that. Close the window. See, there it goes. And now I can reopen it. But I've kind of run out of time and I got to go. But hopefully I gave you a little bit more insight as to how options on futures work. Oh, the pattern day trader. Yes, that rule only applies to a margin account. Correct. That's correct. Absolutely. But as I mentioned, if you're interested in learning more about this with the options on futures in general, the E-mini think tank, as I said, has new trainings, and I just recorded this week. As a matter of fact, yesterday I did part 2 on options on futures, and it's going to be added into new trainings. So I'd be more than happy to share that information with you, along with the documentation that's going with it, to make you more adept at trading the options on futures. And we're going to be doing many of those types of trades in the E-mini think tank going forward as well on a regular basis. So if you're interested, there's the link. You can join me, as I mentioned, by clicking on that link. In addition, if you were to click on getting started, you see you have monthly and quarterly, and you can actually do the free 2-week trial. There's no cost. If you don't like it, you can cancel for free. It's no big deal. But that way you can kind of feel it out and see how you like it, the program. And the nice thing about being in the program is students who are in that have access to me on a regular basis, not just during class time, but there's the send the message feature where you can send me a message. I get back to you as soon as I can. And yes, I did not forget, Alex. I'll look up that question and get back to you today. So does anyone have any questions on options on futures or E-mini think tank? I want to thank everybody for being here for the Training Coaches Playbook, and hopefully we'll see you again in additional workshops in the future, and maybe see you in the E-mini think tank if you liked what you heard. So thank you again for being here. Yeah, happy trading to you too. Enjoy your weekend, everyone. Coming up, we still have some more trading hours left, but 3 more when we finish that. Enjoy the weekend as well, and I'll see everybody soon. So trade